Yeah, hello, back again for business taxation. This is now again something on the corporation tax system, a fourth small chapter on how gains from selling shares should be treated when these shares had been held by other corporations. We are still in chapter 5, and let's first begin with the problem. We have already seen that when dividends are and how dividends are taxed if they are received by another company. Now, then we should look on how gains should be taxed when shares are sold by a company which holds shares in another company. Because you remember our basic insight that we should treat dividend revenue or profits from dividends which you receive alike to profits from selling the underlying shares, because if you create a different economic result for these two alternatives, holding the shares and collecting the dividends over time and selling the shares, and so by this way collecting the present value of the future expected dividends at once. If you treated these two alternatives not alike, then you distort the market and will cause behaviors of the shareholders which you perhaps don't like. So the basis for our conclusions on how gains should be taxed should be again the price mechanism. We must make ourselves clear what a buyer is willing to pay for a share in another company. I hope you still remember that from one of the last videos. Well, let us just repeat and transfer that to the situation where the seller of the share is a corporation and perhaps the buyer too. Imagine that we have again a subsidiary company called S and a parent company P. To make things simpler, I just assume that P holds 100% of the shares in S. If that's not the case, you just have to multiply all the shares and all the formulas with 1%, 2%, or whatever comes up. Now imagine that S has a paid-in capital of 1 million, retained earnings of 2 million, and expected future profits with a present discounted value of 7 million euro. The corporation tax rate for S shall be 40%, and in such a case, a buyer interested in the shares could be tempted to pay 10 million. And that would be again completely wrong from an economic perspective, because in order to make no loss, our investor would be bound to recover the price from the money which flows from the shares to him, her, or if the investor is a company, to it. And that can only be the following amount. You can pay back the contributions, 1 million. You can pay out the retained earnings. They have already been taxed under corporation tax, so they are already net amounts, 2 million. And then you could pay out the future earnings in the course of time, but then you will still have to pay corporation tax on these amounts. So 7 million are not 7 million, but you can only transform them into dividends of 4.2. So we have a maximum amount which you can recover from that firm of 7.2 million. So if you pay 10 million for that, you would lose money. So no reasonable rational buyer will be willing to pay more than 7.2 million. You will not get 10 million. Now, if we transform that into a formula for the price, then we see that the price will probably refund the contributions, so the amounts which you can pay out net and all profits of the company. And we can say that that applies even in the case of the returned earnings, because the returned earnings have been profits of the company which have already been paid, and where the corporation tax has been deducted. So they also are a case where original profits have been lowered by corporation tax So if you pay 2 million for the retained earnings, that is already profits minus the corporation tax. So that seems to be a general insight, a general formula, which applies here. So if that is the case, we again see that the reasonable, rational buyer of a share in a corporation deducts the corporation tax rate from all the profits when he, she, or it determines the price. This way, the seller is automatically charged economically with a full corporation tax on all the profits which have been and which are meant to come. So the price is the contributions, the paid-in capital, plus the profits minus corporation tax on the profits. So 1 minus RC, the rate for corporations. Now, what would happen if we now said that the gain from selling shares is regularly taxable under corporation tax? Imagine that the book value can be set as 0. The gain before tax would be the price minus book value. That would be contributions plus 1 minus RC times the profit minus the book value. If the book value is 0 or is identical better to the amount of the contribution, so if you have been the founder of that company, then we can simplify the equation to gain before tax is 1 minus RC times profit, and the profit after tax is then this amount taken again by 1 minus RC, because you would have on the price 1 minus RC times profit to pay corporation tax, so only 1 minus RC remains. So you would see here we would have twice corporation tax in the economic final effect. That would not fit in with the economic burden which we had if our company said we keep these shares, collect the dividends over time, then they are tax-free and we can retain the whole 1 minus RC times profits, because that is the dividend amount which can be collected from the subsidiary. And if you decide for this and then say, if we need money, we don't sell shares, we just take up the credit and pay back the credit by the dividends coming over time, then you are far better off. So it would be distortion of the market. You can adjust the rule a bit better if you say, but you know that 5% lump sum rule, so after tax, not the full 1 minus RC would remain, but only 95% of that. Okay, then it would remain 1 minus RC times 1 minus 5% times the profits. So there would be a small deviation, but we will later see that that deviation, at least in the German legislation, due to a special rule, will vanish when we talk about the treatment of corresponding expense. Now we could, after having seen here a first deviation, a first thing which is not consistent, if we tax the gains, we could even say, if we tax the gains, what would happen in the course of time if later that result from selling the shares would be paid out as dividends by the parent company to its own shareholders? Then it would end up in the hands of the natural persons, the final shareholders, and then we would have that net amount resulting from selling the shares, 1 minus RC times 1 minus RC times the profits, now taken by 1 minus the income tax rate of the natural persons. So now you see you would have 3 times taxation of the same income in an economic way, from an economic perspective. And that definitively shows that if we tax the gains from selling shares in a subsidiary company, that this leads to a result which on no level complies with the underlying logic of our corporation tax system. What we originally wanted was a corporation tax system where the complete burden, the total of corporation tax burden plus income tax burden equals approximately one full tax burden which a sole trader would have in a comparable situation. This doesn't work. That's definitively clear on no level. And so we would have to think about what we could do. You can only avoid these results if you say we declare the gains tax-free in the middle of the chain, so that the parent company does not need to pay tax. In such a case, the net result from selling the shares would be, the amount, the price, 1 minus RC times the profits, minus nothing. And so this would be 1 minus RC times the profits, exactly the same amount as if you wait and collect the dividends over time. If that money were to be passed on, and it will be in the long or very long run, passed on to the final shareholders, then the total result would be 1 minus RC times the profits times 1 minus the income tax rate of the shareholder. So that is exactly the same result as in case of a dividend being passed on twice. So in that case, we have exactly the total amount of tax burden which we wanted to achieve when we built our tax system, our corporation tax system. So this dividend privilege or participation privilege that you can sell participation tax-free is not a privilege. It is an economic necessity. It is fair. It leads to the correct result. Now you could say, well, but here the state doesn't get the full money. No, that's wrong. The buyer and the seller price in their price calculation already the future corporation tax. And they only do that with respect to the fact that that corporation tax is later effectively paid over to the state. Otherwise, they would not agree on a deduction. So the state will get that corporation tax amount, which is here inbuilt in the price mechanism. It will get it later. Well, now you could say, but this is outrageous. The company collects the money before the state gets it. But on the other hand, when you invest in such a share, when do you get your money back only? You get it back only at the moment when the dividends are paid out. So the investor who buys the share gets that money only at the moment when the state also gets the corporation tax back, or the corporation tax. So at least one of them renounces on his or her money for the same period of time as the state has to do. So it's difficult to justify or to see it here as a kind of unfair treatment of or privilege for the taxpayer. Both have to wait for the same time for the money. And the person who makes cash beforehand gets a deduction. So here's nobody who really profits. So to leave that amount tax-free in the hands of the seller leads to an economically convincing and correct result. It's the only way you can achieve such a fair and non-distorting net result. By the way, not granting that tax privilege would, if you have a functioning capital market, also bring you no advantage, because then all the shareholders would do what I described first, at least the intelligent ones. They would just say, okay, we keep the shares, collect the dividends, and if we need money, we take up a credit and we pay back the credit partly or fully with the amount from which comes in from the dividend. So, well, whenever you have no chance to plunder your taxpayers, you can be generous and you can be fair and stick to the system. For this reason, 8b2 established that selling a share by a company or any other juridical person is under German law tax-free. You should note that in case where a sale then leads to a loss, automatically this loss is also tax-free because this is just then a negative gain. But that is economically also not wrong, because when the book value which the company paid for the acquisition of such a share was already also a net amount. When I bought these shares, I looked to the company and said, well, there are 10 million to be expected. I pay 6 million for them. So if the whole thing goes to the wall and the 10 million never come, I can only book out and have an expense of 6 million net, not deductible from tax. But, well, I already only paid a net amount, so I paid an amount after tax for that potential profits of 10 million, which were to be generated by somebody else. So one can justify that you have to bear that loss also from net income. You would have achieved only a net income in a positive way and you lose only a net amount in the negative way. So everything really fits, is economically convincing, makes sense. Yeah, so only a tax exemption for selling the shares is able to bring along a fair and non-distorting net result. Now, surprise, I mentioned in the last video, I believe that 8b1, the dividend exemption, is not granted in Germany for minority participations where you have less than 10% immediate participation in another company. Then the dividends will be fully taxable. Now, it would make sense to say the same happens when you sell shares, but that was forgotten. I suppose at least it has been forgotten or it was delayed when that 10% exemption, unsystematic as it was introduced into the system. They did not adjust the 8b2 rule. So selling shares is still tax-free in the German system under all circumstances. So also when you have a 1% participation, 0.1 participation, or even a single share. So if a German GmbH also sells a single share in Daimler Car Company or the Bamazon Trade Company, the gain from selling this single share will automatically tax-free under 8b2, which, when we look to the price mechanism, makes sense. The price which you paid for the share was a net price for the net profits which could be expected, and the price which the next buyer gives to you is the value of the net profits which can be expected from that share in the future. So indeed the difference also is already net, as we have shown. So this non-exemption for the small participations is the correct solution. The deviation from the correct solution and fair solution is that strange rule that dividend income below the 10% participation threshold is not exempt but fully taxable. That's the breach of the system, and one should not demand that the breach of the system is extended to other situations. I also mentioned to you already that there are other systems where you don't have a dividend exemption system, but where The dividends are taxable, and then you get an indirect tax credit, which you can credit to your own tax. And now the question is, if that spoils everything, if there should be applied a different logic, if their gains should automatically and always be taxable. And that's a bit difficult then, because imagine now we say our dividends will be taxable, so we pay a full price. Imagine one expects 100 million from a company, and that company has to pay 30% corporation tax. Then imagine I am willing to pay 100 million in full. How could my price calculation be? Imagine I pay for the shares and 100 million. I receive as dividends in cash 70 million. Now I expect that I get a tax credit for the underlying tax of 30 million. So my total revenue would then be 100 million. So my total result would be plus minus zero. Oh, sounds positive. But on the other hand, if my total result is really plus minus zero, my problem is at the moment where I take out every money from that subsidiary, the book value of that share naturally goes down. I have to write it off. It loses value. So indeed, I have paid out 100 million and I get 100 million as revenue, so the result is plus minus zero. Now, if taxation in that country sees it exactly this way, then my taxable profit would be zero. Now, the indirect tax credit is usually a tax credit which does not entitle to a refund. Now, if I have a tax result of zero or below zero, I cannot use the 30 million to lower a tax burden of mine. That in turn would mean the 30 million tax credit is, if I don't make a profit, worthless for me, or as far as I don't make a profit. And that would mean if I really am willing to pay 100 million for 70 million in cash, the 30 million would have no advantage for me. I would lose them. And so that would mean, under that circumstances, the share is not worth 100 million, but only 70 million, as in the case of the dividend exemption system. Now, if a state would say, we regard these things differently, you are taxed on the dividends, and the amount which you write off for the shares can be set off against other gains or other profits of your enterprise, then it could be, so if you end up with a positive amount for taxes on the dividends, then it could be that the 30 million have a value. And that explains why at this moment I personally begin to become so confused that I don't dare to think more myself into the details of that situation. My prognosis is, if you have an indirect tax credit system, developing a non-distorting formula how you should tax the gains from selling shares is a challenge, to place it like this, especially when the underlying profits of the company, of the subsidiary, do not come from only one country, but also from 2, 3, or 5 different countries. 100,000 at 20% tax from one country, 100,000 at 40% tax from another country, but your parent company has only 30%, so that the 40% tax credit will not be able to be used, and blah blah, and so on. 5 different countries, one corporation, paying 5 different rates. Then how and which maximum price you can pay, I do not know. So if somebody wants to write a bachelor's thesis, a master's thesis, or a doctoral dissertation, and to analyze such a situation in detail and then compare with those solutions which have been found by Anglo-Saxon countries or other countries in the world, as far or if and how far these solutions comply with what we then find out under an economic aspect, yeah, then that person can be congratulated. Would be definitively a challenge. Well, that should be enough for today, and the next time we will probably have to talk about how expenses in relation to such tax-free gains should be treated under a system like the German system, so under the 8B rules. And till then, I wish you a good break. Enjoy the time till the next video on this series comes out. Thanks for watching. Hope to see you again soon or sooner. And goodbye till next time.